Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for July 6, 2026. Last week, investors received another reminder that markets often move ahead of the economy. The Dow Jones Industrial Average reached another high record while the S&P 500 also advanced for the week, though it finished virtually flat on Thursday as a tug-of-war played out beneath the surface. At the same time, the Nasdaq lagged as investors continued rotating away from some of the largest technology names into industrials, financials, and other value-oriented sectors. The central question facing investors is whether this broadening market leadership can continue as inflation eases and interest rate expectations evolve. The biggest catalyst came from the June employment report. The economy added approximately 57,000 jobs, well below the expectations, reinforcing evidence that the labor market is gradually cooling. But rather than viewing weaker employment as entirely negative, markets interpreted the report as increasing the likelihood that inflation pressures continue to moderate. Treasury yields declined following the release, helping support equity valuations and providing additional momentum to interest rate-sensitive sectors. While technology shares paused after an impressive run, market participation broadened. That is generally a healthier development because stronger markets are built on wider participation rather than leadership from only a handful of companies. Internationally, tensions in the Middle East continued to ease. Shipping activity through the Strait of Hormuz improved, helping to stabilize global energy markets. Oil prices remain contained, reducing one of the major inflation risks investors have been monitoring throughout the spring. The dominant market narrative remains unchanged. Markets are increasingly pricing in stabilization. However, and as I've said many times, stabilization is not normalization. Inflation has improved considerably from its peak, but it has not yet returned to the Federal Reserve's long-term target. Economic growth continues, but at a slower pace. Labor markets remain healthy, though hiring is becoming more selective. The distinction matters because financial markets respond to expectations about future conditions, while economic reports describe conditions that have already occurred. Markets move first. The economy follows. Understanding that difference helps investors avoid emotional reactions to headlines. So the upcoming week contains several economic releases, but investors are already looking ahead to Tuesday, July 14th, when the Consumer Price Index will be released. That report may become the most important inflation update for the summer. If inflation comes in lower than expected, markets could gain confidence that price pressures continue easing, potentially supporting lower treasury yields and equity markets. If inflation surprises to the upside, investors may reassess expectations for future Federal Reserve policy, creating renewed market volatility. Between now and then, investors will continue monitoring Federal Reserve commentary, Treasury yields, and additional signs that inflation is continuing its gradual decline. While headlines surrounding the Middle East have become less intense, geopolitical developments remain important because they influence financial markets through a predictable chain of events. Geopolitical disruptions can affect energy prices. Energy prices influence inflation. Inflation affects treasury yields. Treasury yields influence stock valuations. For now, improving shipping conditions and relatively stable oil prices have reduced immediate inflation concerns. That represents stabilization, not necessarily a permanent return to normal conditions. So what does this mean for an investor? If you're a person with a higher risk tolerance, this environment continues to reward patience and selectivity. A broader market rally creates opportunities beyond the largest technology companies, but chasing short-term momentum is always risky. For investors with lower risk tolerance, diversification remains essential. Maintaining appropriate liquidity, emphasizing high quality fixed income where suitable, and remaining committed to a long term financial plan continue to be prudent strategies. Remember, successful investing is not about predicting every market move. It's about maintaining discipline while understanding why markets move. As we head into next week, I'm watching three things. First, Treasury yields. Their direction will continue influencing stock valuations across multiple sectors. Second, lower energy prices. Continued stability in oil markets would help reinforce the broader disinflation trend. Third, market breadth beyond technology. If leadership continues expanding into additional sectors, it would provide further evidence that the current rally rests on a stronger foundation. Stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.